Welcome back everyone, it's your boy Alex Winkler, and in this video we're going to be covering a very straightforward topic: short selling. Last weekend I had one of those horrible experiences where you're at a party and you're trying to explain something and it just doesn't work. Therefore, I was inspired to make this video in case you are ever in the same situation. Without further ado, let's go ahead and break down what short selling is and how it works using Apple. And that's what's on this chart. Now, this is a daily chart of Apple, and it's had quite the nice run up lately. Let's actually zoom in a little bit more. All right, so now let's imagine that we have this guy named Bob. And Bob just got done shorting Tesla. He was completely crushed by the spike and he's all upset. He really wants to bet against the market, and he has this new great idea that the next thing he wants to short is Apple. So let me just go ahead and draw a little apple here so we know what we're talking about. Ooh, red, that's very, very aggressive. All right, so there's Bob's great idea that he wants to short Apple. Maybe we can add some eyes in here to show how excited he is. Now that is a shady looking smile. Okay, so Bob goes and calls his broker and he's like, yo, broker, what's good? I have this phenomenal idea that I want to go ahead and short Apple. Now, the broker is obviously excited. And what is a broker, by the way? Broker is anything from TD Ameritrade, Robinhood, which is a pretty popular platform, or the new Webull, which seems to be taking over the internet by storm with their 2 free stocks. And the reason a broker wants to give you shares to short is because they make a profit on the borrowing interest rate. All right, now to get back to the phone call, we were just telling the broker that we have this great idea that we want to short Apple, right? And this is the broker right here. And the broker is obviously like, that's a great idea. Let's go ahead and do that. Let me give you 1 share of Apple. So now we have this beautiful 1 share of Apple that we are borrowing from our broker. And to give you guys an idea, that's like going to your friend's house and being like, hey, can I borrow this DVD? It's really cool. I want to watch it. And your friend's like, yeah, sure, you can borrow it for as long as you want. Just give me like 10 cents a day. And by the end, since you're super lazy, it ends up costing you $9. So it's basically like the OG Netflix deal. So now you have this share that you don't really own, but you're borrowing it from your broker. The borrowing fees from the broker are usually not too much, and they vary quite often from broker to broker, so we're not really going to dive into that topic. In this video, we're just going to be focusing on how Bob, the legendary Tesla shorter, can now short Apple to make profits. You might be wondering, how does Bob actually make any money from this? Because right now he's just losing a few percentage in terms of fees that he pays his broker every day or week or whatever deal they have set up. Well, what Bob does is he takes this share and he sells it into the market. So let's go ahead and analyze that. Right now, the price is at $249. Let's just say $250 to make things a little bit easier. So he goes ahead and sells this share into the market, and now he makes $250. So now Bob has no shares, but he has $250. Now, since Bob is legendary at technical analysis, he goes ahead and analyzes the market, and he thinks that there is some serious support right around this area at $170. So what happens after Bob sells his 1 share into the market, the price maybe spikes up a little bit, he gets a little sweaty, but ultimately then there is a big sell-off and Bob is relieved as the price keeps wandering down. Now, Bob has an order waiting to buy Apple back at $170. And lo and behold, a few weeks later, that price, the price of Apple goes to $170 before having a little bounce and maybe a reversal to the upside and then just running to new all-time highs. Now, Bob bought right in this area. It was a pretty perfect buy or cover, as you say when closing a short position. And Bob was super stoked. I'll just draw a little circle where Bob bought his Apple share back and where he originally sold his borrowed shares. So pretty sweet trade, Bob. Let's finish up this little math equation here and see how much Bob has earned. Well, at first he earned $250, but he was down a share of Apple. Now the price went down and he had to buy that share back. Well, he didn't have to, but he wanted to because he thought this was a good time to buy it back, and he bought it back for $170. Now let me go ahead and put a minus there, because since he had to buy a share back, that means his cash goes down. Ultimately, this leaves Bob with $80. Let me just go ahead and put this 80 here. Hopefully it's not too much in the way. So now Bob is super happy. He's like, woohoo! I now have $80 and a share of Apple. Things are looking good. So he gives this share of Apple back to the broker, and now he keeps the $80 profit. That was a good day of trading, or I guess you can say a good few weeks of trading for Bob. Now, next time Bob is at a party, he goes and tells everyone about Apple blowing up his ego, and he gets even more excited, and eventually he turns into a bird and flies away. Okay, so now let's do a very quick overview of what really just happened. So Bob had an idea. That's where it all started. That is step number 1. Step number 2, Bob borrows shares from his broker. So now he has a share and a small interest rate, I guess you can say, on that share that he borrows. Then he goes and sells that share into the market. So now, ooh, that is an ugly looking 3. So now he has cash and no shares. Then on step 4, when he goes and buys back his shares, he has cash and he has shares, which is pretty cool, obviously. Now on step 5, also not the most good looking step, or 5. Now he just is left with cash when he goes and gives those shares back to his broker. And that cash, again, was that $80. What you really want to be thinking about when it comes to short selling is the borrowing. You're borrowing shares, you sell the shares into the market, you get money for those shares, and then you need to give those shares back. So what do you need to do when the price goes down? Ideally, you buy shares back from the market price, then you give those shares back to the broker, and you keep the difference. Don't forget to leave a like if you enjoyed this free content. Subscribe and hit that bell icon too if you want to see some more, and learn more about trading, investing, and finance topics in general. I'll leave you guys with a little bonus lesson, and that's basically something you probably noticed in this formula already. The most that Bob will ever be able to make from this trade is $250, and that is if the price goes all the way to 0. Or for math purposes, let's just say it goes to $1. If it goes to 0, to be honest, I've never shorted a stock that disappeared, so I can't really say what happens, but I assume that you would just simply walk away with all the winnings, or your brokerage would ask you to cover the position before the stock completely was delisted from the exchange. Anyway, let's just say that you had to buy it back at $1, because at $1, stocks get delisted from certain exchanges such as the NASDAQ anyway, and you had to go and cover this position. So now it only costs you $1, which means you make $249. Pretty sweet deal. Now let's take this the reverse way. What would happen if Apple continued to climb to the upside, and instead of having this little dip right here to the downside, it just continued going up, and the price goes all the way up to $750? That would be really bad, because now Bob would get a margin call from his broker, which basically means you need to add more cash to your brokerage account to make up for these gigantic losses, or close the position. And since Bob is out of cash, he needs to close the position, and that would force him to buy back Apple at $750, and that is just a heavy fat daddy loss of $500. And that is why people say that short selling is very dangerous, because ultimately you can lose an exponential or an indefinite amount of money As normally, if you buy something such as a stock or maybe a cookie, the most you will ever lose is the price of that cookie. With short selling, it's like your grandpa still owns that cookie that he originally sold to a friend, but now needs to buy it back 30 years later with inflation. So that cookie he only bought for 3 cents is now $3, which now leaves your grandpa with a big fat frown. So guys, remember, short selling can be great, but if you fly too close to the sun, your wings can melt and you can fall right back down. Again, guys, if you enjoyed this free content, go ahead and leave a like for me and the YouTube algorithm. Share this video with a friend you care about and you think can benefit from this video. If you want to learn more about trading, go and subscribe. See you again soon. Till next time, stay safe and make some awesome trades. Ciao, ciao.